There's 446 companies across the globe that went up 1,000% or more during that 10-year time period. 87% of those started their journey as a microcap. My intention when we purchase something is to hold forever, but very few, if any, will earn that right. I want to find a Picasso. I want to find really an overqualified management team running an obscure small business that is running a unique business that can sustain double-digit growth that is profitable. You might find 10 or 12 per year, and you pick up the phone as quick as you can or get on a plane as soon as you can to meet them, and you might pull the trigger on 2. If I can just find something that is a $10 million revenue business earning $500,000 that I think can grow to $20 million business and earn $3 million, that's a 5-bagger in my world. It doesn't need to become the next Google, the next Meta, the next anything.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
In this episode of Excess Returns, Jack and I have a great conversation with MicroCap investor Ian Cassel of MicroCap Club and the founder of Intelligent Fanatics Capital Management. We talk with Ian about all things microcap investing, business building, and how he thinks about finding an edge in ultra small companies with management teams who are building good, profitable businesses that offer investors solid long-term opportunities. Of course, it's not easy, but Ian helps us understand the opportunity in the corners of the market where most big investors aren't playing. As always, thank you for listening. Please enjoy this discussion with Ian Cassel.
Hi, Ian. Thank you very much for joining us today.
Thanks for having me on. It's a pleasure.
I always enjoy conversations with guests when we have guests on the podcast where we haven't really had a chance to talk about the topics that we're going to talk about today. And with you specifically, that's microcap investing and sort of your process that you go through when looking at microcaps and building portfolios of smaller companies. But I thought where we should start, and it's important to start, is this concept or idea of intelligent fanatic and sort of where that comes from, what that means, and sort of, because I think that's an important thing to sort of get up front as we sort of dive into this microcap investing idea.
Yeah, and I appreciate you starting off with that, because not only do I think it's important with any small business investing in the right leader, but I know it's really the number one priority for my investing strategy in particular. And really the term intelligent fanatic was derived from one of the speeches that Charlie Munger gave, and he referred to an intelligent fanatic in one of those speeches as a sort of a great business builder, someone that started a business from scratch, grew it into a business that dominated its niche, its geography, its industry, and not only dominated it for 1 or 2 years, but did it for decades. And he mentioned several individuals in that speech as well as others, and some of them, quite honestly, they're probably well known now, but back when we co-authored the 2 books that we wrote on Intelligent Fanatics in 2016, 2017, they were rather unknown. People like Les Schwab of Schwab Tire Centers, or somebody like a John Patterson who founded NCR, National Cash Register, or Ken Iverson from Nucor, these types of folks, which, thanks to David Sinra, in the Founders Podcast and other ones like that, these people were kind of really well known. But back then, even in 2016, only being a few years ago, not very many people have heard of them. And because a lot of them ran private companies. And so what me and my co-author decided to do, who was also a member and microcap investor, we decided to kind of research these individuals that Charlie Munger mentioned and really kind of just write a quick 25 page kind of overview of their personal life, their business life, how they grew their businesses, and pull out some important lessons from their lives and from their experiences. And so I think the first book was 8 Intelligent Fanatics we highlighted. And then we wrote a second book a year after that, where these weren't businesses that Charlie Munger mentioned, but there were ones that kind of fit that framework. We pulled, I think, another 10 in the second book. And, me and maybe 10 other people actually read the book because we didn't sell too many of them. But it was a fun project for me because I've always wanted to sort of fine tune my lens for finding great leaders early, because I think that's important when you're trying to invest in small businesses. You can't grow a small business into a larger small business, unless you have good leadership. And so I always wanted to fine tune my lens for kind of the qualitative element of finding great leaders early. And that was really why I spent the time kind of on 2 or 3 years writing those 2 books with my co-author. And, it really helped. And ironically, probably the biggest takeaway from writing those 2 books and studying, several hundred of these leaders was really not to focus on the leader themselves per se, but quite honestly, the types of folks they have around them in their organization. Because what you found was, people that were able to scale a business from, 5, 10 million to 100 to 200 to a billion, they can't rely on themselves. They put great people around them. And oddly enough, before writing those books, I probably put too much effort and attention into the founder, him or herself, instead of concentrating on the team that they were building around them to see if they were building something that was truly scalable. And probably the number one takeaway through that exercise for me.
Yeah, that's great. And it's funny because if you think about Buffett, right? Like obviously everyone knows who Warren Buffett is and he gets all the headlines, but Buffett's very quick, or when he writes his shareholder letters and when he's talking about the people he's putting in charge of those divisions at Berkshire, I mean, it's he knows how to allocate the capital and build a great team. And it sounds like it's a similar thing to what you found in those founders.
Yeah, that's exactly right. I mean, the number one thing that attracts us to a new idea in the portfolio is the people and the leader behind it. And I know we'll get into that in a little bit, but that's kind of where it overlaps with my investing style.
So in speaking about the microcap universe, can you just kind of tell us what that looks like in general, maybe? And it doesn't need to be exact, but how many, stocks generally are on microcaps, and is it sort of sector, or is one sector maybe a little bit more dominant in microcaps, or how does it look?
Yeah, I think in general, let me just start sort of at the top. I think many people, at least in the Western hemisphere, define microcap as sub 500 million USD market cap. And that might change depending on the geography you're investing in. For example, in India, a microcap might be sub 100 million USD market cap. So it really depends. But I think, for mainly, we're talking about North America, Europe, Australia, you're looking at 500 million market cap or less. And so when you kind of look at all public equities in the whole world, in the globe, 60,000 public stocks, roughly half of them are microcaps as that definition, more or less. And, really when you go then to North America, so if you just look at United States and Canada, you have 23,000 total stocks that trade in the US and Canada. And I think it's around 13,000 that are under 500 million market cap. So it's about 56% of the investment universe public stocks in US and Canada would be considered microcap. Ironically enough, if you're just looking at Canada, I think Canada has around 3,600 listed stocks, and I think 83% of them would be considered microcap by the definition of sub 500 million. So I'd like to say Canadians, they don't know they're microcap investors, but they are if they're investing in their own markets. So microcap is, a big portion of the public stocks, that are out there. And to kind of give I think this research was done 7 or 8 years ago, but if you were actually to add up all of the microcaps in the United States together and aggregated their market cap, I think it's roughly 500 billion, and it's funny to think about today because I think there's 15 or 16 individual stocks that are valued at 500 billion or more today. That kind of gives you a sense of how big and how small the amount of companies, how big and how small the total aggregate market cap value there is in US microcaps. I think Berkshire has 280 billion in cash. When you think about it that way, they divide by the float of every micro.
Right.
I mean, it wouldn't be a good investment decision. Therefore, I'm not worried about that. But, kind of break it down further. I mean, a lot of people might get confused with the amount of stocks that actually trade in the US. And a big part of that is mainly the fact that the OTC markets is where a lot of microcaps trade. And so I think there's like 14,000 equities that trade on OTC markets, 7,500 of them are microcaps, so a big portion of the microcaps that trade are on the OTC markets. And, to put that into perspective, like the major indices here in the US, the New York Stock Exchange, the NASDAQ, there's roughly 5,600 stocks that trade on the NYSE and NASDAQ. About 2,300 are microcap. So there's actually more microcaps that trade on OTC markets than there are that trade on the entire NYSE or NASDAQ combined of all.
And I'm just curious, does the sector breakdown follow like something like the S&P 500? Does it map pretty closely to that, or is there a lot of differences there?
No, I mean, again, kind of depends on geography, but I think if you're looking at the US, I think it's heavily weighted towards healthcare, maybe 20%. Have maybe another 20 or 25% actually in financials, because there's a lot of small banks that are listed. Things that I think there's like 1,000 or 2,000 microcap banks, in the US. And then I think it goes down from there. I think like roughly 10% is usually industrials, IT technology, another 10. And obviously there's industries like utilities where there's just not many small companies.
And from your perspective, I mean, that's more companies than I thought I would have guessed. But it's probably good because there's a lot of fertile ground there to find ideas. But have you seen, I'm just thinking like, in the last couple of years, there's been obviously a lot less IPOs. Just in general, you've seen a trend in less publicly traded companies overall. So it's shrinking, even though, like you said, there's, a couple of thousand microcaps. So it's not like but does any of that affect sort of the quality, though any of those trends affect the quality of microcaps that you're seeing sort of come online or not really?
Yeah. I mean, I think you hit the nail on the head. I think probably the number of microcaps has stayed relatively the same. I mean, even when you look at the number of IPOs, I think in 2023, there's around 150 IPOs, about 80% were microcap. I think so far this year, when I actually looked at it, preparing for this conversation, I think there's 180 IPOs, and I think 73% are microcap. There's still, believe it or not, 100 SPACs done per year, after 2021. And probably a vast majority of them are microcap. You still have 100 to 200 reverse mergers done per year, which that pre-2010 was the predominant way small companies went public, were actually reverse mergers, not traditional IPOs. There's still 100 to 200 of them done per year. Those reverse mergers is actually an area that I haven't seen written about a lot, but pre-2010, here in the US, there would be 800 reverse mergers done per year. And yes, many of them probably shouldn't have been public. And, it's kind of the law of the 80-20 rule, but I think a lot of the decline in the overall market, the listed companies, is a result of that 800 per year turning into 100 per year. Because there's just fewer companies that are going up and out of the microcap ecosystem and becoming listed companies. And so, yeah, I mean, but like we said, like there's 9,000 microcaps, really in the US that exists. And, that's a pretty big sandbox. I mean, you compare that to, you have a large cap domestic US portfolio manager on here. Their sandbox is 850 companies, so mine's 9,000, and so there's still plenty of microcaps that exist. The issue has been kind of what is the quality level of those new issuances coming onto the market. And I think that is where we've seen a degrade of that, and I love, as a microcap investor, a proponent of microcap investing, I love to point to Walmart being a microcap when it went public in 1970 on an inflation adjusted basis, or even Berkshire Hathaway when Buffett took it over, when he did, that was actually a microcap inflation adjusted. I love to point to those things, but there's fewer and fewer real small companies going public when they are small. And when I say real in air quotes, I just mean profitable and growing real businesses. And you still have plenty of companies trying to raise $10 million to fund a phase 1 drug, in a binary event. But you do see fewer real companies going public. And what's become more important as a microcap investor over time is, because of that, not to be landlocked to the US, because you still have real small companies going public in places like Canada or Australia. And you just have to be open to going to these other jurisdictions, as you should, because in today's day and age, especially, the English speaking, similar rules of law, I mean, there's no reason not to look at these other jurisdictions.
Can you talk a little bit about the research supporting microcap investing? I mean, this has been a little bit of subject of the debate in our world, in the factor investing world, because everyone's debating whether the size premium still exists or not. But what research do you see on your side in terms of supporting microcap investing in general?
I think it's a good question, because I think some of the data that I have is dated, quite honestly. I think actually a member of ours, Mark Vonderwell, went through and looked at all the CRSP data from 1927. I think his ended 2016, and obviously shows the smallest decile returned 17% versus the next decile, which was 12. 500 basis points of outperformance. Obviously, that's probably closed somewhat in the last 7 years or 8 years since that data. I haven't seen updated data on that. I found that probably the best research that I've seen recently was, I don't know if you guys probably have read it, but it's with Jenga Investment Partners out of the UK. They put out a study on global outperformers. They looked at all stocks that went up 1,000% or more between May 2012 and I think May 2022. So it's somewhat recent. And there's 446 companies across the globe that went up 1,000% or more during that 10-year time period. 87% of those started their journey as a microcap. And, and that's over and above the fact that microcaps are probably 60% of the market anyway. So it's, it's more so than normal, I should say. So that's probably the clearest evidence that's been more recent, and that ended in 2022. And, I think the size offers some signal as a factor, but I think there are bigger factors such as illiquidity and, quite honestly, just simple profitability that lead to outperformance. And I think when you combine small, illiquid, profitable, that is the secret sauce. That's the signal. And we even, quite honestly, we even developed a little index inside MicroCap Club where, of all the companies that have been profiled on there, screen them all for trailing 12-month profitability, equal weight them in an index, rebalance every quarter. And it's outperformed the NASDAQ this year. The drawdowns are less when the market draws down. It's been pretty, I haven't back tested it, but it's pretty interesting just since January how that has performed versus the NASDAQ and S&P. When you have like days when the NASDAQ and S&P are down 1.5%, this 395 equally weighted profitable microcap index is down half that on the down days. And it's fascinating to see that. And I think that there's some signal there. But with what Jenga Investment Partners, what they showed was that, yes, 87% of all outperformers during that 10-year period were microcap, and 82% of those were profitable, or I think 90% had a history of profitability. And so what that tells us is not only want to look at small, but you want to look at profitable.
Yeah, and to your point, I would think this would be a bad area, and correct me if I'm wrong about this, but I would think this would be a bad area to index. Because just like the problems with the Russell 2000 in terms of lots of junky companies, like I remember AQR's paper, which I think has the best title of all time, which is Size Matters If You Control Your Junk, where they were effectively talking about this idea. So I would think you don't want to buy an index of microcap companies. This is something where you probably want to be looking for the best companies.
Yeah, I mean, I've always said that the worst indices are the microcap indices that iShares has, or even some of the larger. Microcap isn't meant to scale. And so when you see it in an investment vehicle built for scale in microcap, it's usually just meant for asset gathering. And that's just not where you're going to outperform. In fact, you can look at the long-term performance of all those types of vehicles, and they underperform everything. Microcap is a place for stock picking.
You alluded to this before, but you had a great quote: liquidity trumps size as a return predictor in the microcap space. And I'm wondering if you could just expound on that a little bit.
Yeah, and I mentioned liquidity a little bit couple of minutes ago, but I think it was Roger Ibbotson, who was a Yale professor. He used to do an annual update on a paper that he called Liquidity as an Investment Style. And he looked at all equities from 1971 to the present, and he would publicly update it, I think, up until 2017. And since then, it's been kind of closed off, and unfortunately, it's not public. But he looked at all public stocks in the U.S. from 1971 to the present, and he categorized them by market cap classes of microcap, small cap, mid cap, large cap, and he looked at them by illiquidity. And what was interesting was illiquidity had some signal across all those market cap classes. It was less signal at the large cap, area. I think illiquid large caps produced 11% return during that time period versus 9 for liquid large caps. I think illiquid mid caps were something like 14% return versus 8% liquid mid caps. Now, microcaps is where you had the biggest variance there. You had illiquid microcaps performed 16% annual return versus this is really interesting, versus 0 on the liquid microcaps. So, actually liquid microcaps for 0 return during that time frame. And we can go down that rabbit trail if you want there and why I think the 0 is there, because I find that the most interesting of all this. And my reason why I think it was 0 is because the liquid microcaps are institutionalized. Anything 200, 300, 500 million market cap. By that point in time, they're probably 10 to 40% institutionally owned. They're indexed through the iShares indices, the Russells and everything. And quite honestly, when you get to a bear market, a lot of times, it's risk off across the board and allocations go down, and they're the first things that people bid whack, and they perform really poorly in bad market environments. And so that's why I've always thought that the liquid microcaps perform so poorly, over time, is because of that. And it's also a function of why in my strategy, we look at the very small microcaps that have no institutional ownership.
We're going to talk about your approach in a second, but I'm wondering, have you seen any change over time in terms of how the market reacts? Like when you find a good company and they have good news. And the reason I ask this is something we've talked about a lot in the podcast, is this idea of indexing at the larger stock level. A lot of people who are small cap investors, and David Einhorn touched on this in a recent podcast, are saying so many people are indexing right now. Nobody's paying attention to the small cap space. I get good news on my companies. I get fundamental improvements. The stock doesn't go up because no one cares. Like, is that at all applicable in the microcap space, or is this so far departed from that it doesn't really matter?
I think you see some of that, but I think it's mainly, I would say that his commentary was probably more towards his flavor of investing. This idea of reversion to the mean based on fundamentals, and multiples. I think that has somewhat departed, from the way it used to be. But I mean, quite honestly, if I was getting a beer with both you guys, I mean, I think blaming the markets and blaming anything or anyone, kind of for this stuff is just an excuse for underperformance. We're all dealing with the same circumstances, and I mean, let's just take a factor like deep value or even value, which I think we would all agree that David Einhorn is in. There's still people that are in that factor that are crushing it. There's people like Michael Melby, who runs Gate City Capital. He's a friend of mine. He's a member of MicroCap Club. I mean, he's put up 21% net CAGR since 2011 in a deep value strategy. I don't see him complaining about indexing. So I think you're always going to have people just complain because their performance is bad, or complain because there's nothing else to complain about. But, I think for me, I don't see it too much. For my investing style, I'm trying to find things that are undervalued that can get overvalued, and I do think about who is going to buy my stocks from me, hopefully after they 5 or 10x. Who is that investor or institution going to be? And I think historically what we've found, and anyone's found, is that institutions are always attracted to fast-growing, profitable businesses they don't own. And the one factor that everybody is attracted to, even if you're deep value, is growth. And so there has to be some component of growth there that is kind of like the moth to the flame for institutions. And that's why growth is a decent part of kind of what we look for as well.
Yeah, you just touched on a point that's been a big lesson from my career, which is like those of us that have value as part of our strategy have wanted to like shake our fists at the Fed and be like, oh, the Fed is killing us, but you got to play the game that's in front of you. Yeah. I mean, it is what it is. And like, you can complain about it or you could do something about it. And that's one of the biggest lessons I think I've learned in my career. I want to get into your process a little bit because you mentioned growth. And so I think that probably is a cornerstone of what you're looking for. But at a high level, when you're looking for a good microcap company, how would you describe your strategy for finding?
I think it's a good place to start, because I think a lot of people, when they think of microcap investing, they think of everyone being the same. But the same flavors of investing are found down in microcap that you can find in large cap. And so, I would characterize, and then in microcap too, there's certainly folks that focus just on that larger microcap segment, the 200 to 500 million market cap, because they are more liquid. They probably do have more robust businesses, things like that. So for me, I really focus on that smallest decile of the market. So that's sub 100 million. And predominantly, I'm really looking to invest in these companies initially, when it's sub 50 million, 50. And these are very small. They're very illiquid. There's no institutional owner, hopefully, of them, but me. I hate calling myself an institution now, but I want to find them first, and that way I have the full curve of discovery ahead of me, if that business executes. And I think when you're looking at these small businesses, you can still find these very unique ones. And I kind of like refer to them as Picassos. I want to find a Picasso. I want to find really an overqualified management team running an obscure small business that is running a unique business that could sustain double-digit growth that is profitable. And that's a mouthful there. But those are what does that do with Picasso? Well, these situations, they're just rare. They're scarce. There's not very many of them that exist. And these, like I said earlier, these are the types of situations that institutions will ultimately be attracted to their velocity, their scale, their profitability, and they reach an escape velocity where hopefully they can get out of microcap, into small cap. And so that's traditionally what I'm trying to find. And it really starts with finding the great leader. And so a lot of, our process is just, focused on finding great management teams that are just overqualified. And what I mean by that is I like to see previous success. I like to see a management team that built up something from 0 to 100 million before. You kind of see the glimmer of the bringing the gang back together again to do it again in something small and obscure. And by this time, they each made $100 million each, and they're going to backstop the funding of the company themselves. They don't need Wall Street or anybody's money to do it. And there's that's usually the trigger point that gets me interested in something new. And you don't find too many of them every year, but you might find 10 or 12 per year. And you pick up the phone as quick as you can or get on a plane as soon as you can to meet them. And you might pull the trigger on 2. And, and that's predominantly what gets me excited is actually the people first. Then it's usually the business second. And maybe another kind of part of our flavor of investing, it's more so in the portfolio level is just, we are concentrated, and concentrated is just a way of saying the portfolio is volatile. And we like to let our winners run, which makes the portfolio even more volatile. Our top 3 positions are 55% of the portfolio, or top 5 or 75% of the portfolio. And so it's just, it's a very volatile, I like to say, we want to target, a 20, 25% CAGR, but it looks like this, and it's important for anybody involved in the way we invest to be in it for a duration, a 5 to 7 year period, because depending on when you come in, you can, the next year you could look like a hero or villain or an idiot, and so you just need to be in it for a full duration of time.
How does a company get on your watch list? I assume you have a watch list of companies you're following that could potentially be included in your portfolio. Because as you mentioned, you have less than 10 stocks in your portfolio, right?
Yeah, I would say it's around 12. When I think about our portfolio, I think of it almost like a professional sports team where we have our veteran players. They're the largest positions in the portfolio. They earn the right to be there because we've owned it for a period of time and their equities have gone up, quite honestly. They've earned that position size. And then we have, another 7 below that I would kind of call the rookies on the team that you bring on. They kind of fit your framework. You give them some playing time. If they succeed, you give them more money or you bump them up in position size. If they don't, you kick them back off the team and bring on somebody else. And that's naturally where some of the turnover occurs, is kind of among the rookie team players when they're trying to find the next batch of talent. And so that's predominantly how the portfolio looks. So it's usually around, I would say 8 to 14, depending on any given time.
And what gets something on the watch list? I'd assume you're about as far from us as possible, in that you're probably not running a bunch of quant screens to say, here are the stocks that should be on my watch list. I assume operating in the space, you're probably finding these more organically.
Yeah. I think you usually find ideas in, a few different areas. I think there's three ways you actually go out and find the ideas, and then 2 ways they come and find you. The 3 ways you find ideas are just through brute force kind of research, A through Z. kind of Warren Buffett style, going through journals and manuals. The second way is screens. Third way is researching. You're researching something and you bump into something else. That's how you find something new. And then the two ways they find you is just networking, which has become really important, and relationships. And what I've found is we use brute force a lot. When we screen, we're not screening for quantitative criteria per se on fundamentals. What we're screening for is large insider purchases, rights offerings, anything that triggers us to seeing skin in the game and a transformation that has taken place. And, because that's what we're trying to find. I mean, when you look at like what multi-baggers are, I mean, it's a combination of earnings going up and multiple expansion, and so if you can find something at the point of transformation, it's probably trading a value price, and hopefully it'll get a growth multiple once it starts executing. And so on the screen side, it's mainly around insider purchases more than anything. And we have something set up across the globe that, kind of flags anything over 100,000 USD kind of purchase. We take a look at and see if there's any signal there to that type of thing. More and more, since I've been doing this for 20 years, the ideas are coming to us through relationships. And I think that's ultimately any stock picker, what the goal is that you're actually having ideas come to you in different ways because of relationships you've built with other investors, other CEOs, other people that you're doing scuttlebutt research with, where you showed value to them, they're reciprocating, and you build up that trust over time of 10 or 20 years. And all of a sudden, when they find the next deal, they want you a part of it because they see the value of having you as a shareholder and have somebody on the team. And so more and more, we're seeing ideas come to us kind of through that relationship component. It's one of the things that, founded MicroCap Club in 2011, it was really just a pet project of mine where I just wanted to get as many smart people in my niche of investing on that site as possible so I could see what they liked and why. And that's still what it is today. And it's been an incredible resource just for that networking and relationships component to finding ideas.
And I would bet that must be one of the coolest things about operating in the microcap space. Like if you take it to the other end of the spectrum, like I can talk to all the people I want about NVIDIA and what's going on there, but I'm probably not going to have much of an edge over anybody else. But I would assume like in the microcap space, you can develop an edge doing those kind of things.
Yeah, you can. And the relationship side of it too, not only with other investors, but I mean, we're very hands-on as investors with the companies we invest in. We have close relationships with the management teams, with the CEOs of everybody we invest in, and something that I've always enjoyed doing and something that I kind of cut my teeth with when I was in my 20s. Just talking to management and stuff like that was important to me. And so it's definitely a cool thing about the microcap space. And the other cool thing about microcap, I think, is that not every investor in microcap has the same kind of background where they, kind of went to the same business school, went to the MBA, did their internship at Goldman Sachs or whatever it is. Like every microcap investor is so independent and so different. I mean, there's a lot of small business. Some of the best microcap investors I know are just simply small business owners because they understand small business. They've run one or they ran one. You have lawyers, you have doctors, you have every background of person, which also lends itself well for a community because you can usually get due diligence done very quickly because usually somebody on that community knows something about something, some area that you want to look into, so.
You mentioned multi-baggers before and some of the characteristics. Are there any others you can talk about in terms of, you've probably had a lot of multi-baggers and you look back and say, what were the characteristics when I first bought them that I saw that led to this success? Like when you analyze your multi-baggers, are there certain common things you find?
I think it's kind of getting back to that point I made earlier. It's like when you can find an overqualified management team inside a small, obscure company that is fundamentally undervalued, where they haven't unlocked the growth engine yet, and that's where you can almost see the next 50 or 100% return already just from 3 or 4 other people finding out about the stock, and kind of getting the stock up just because it's undervalued, and then their execution takes it up another level or two over time. But I think it's really just the combination of just earnings growth and just multiple expansion. And the cool thing about MicroCap too is I'm not looking to find the next Google. I'm simply trying to find a $10 million business. This sounds obscene to most people when they know that there's companies that do 10 million in revenue that are publicly traded. It's probably smaller than the largest company in your town, but they're publicly traded. You buy in your Schwab account. If I can just find something that is a $10 million revenue business earning 500,000 that I think can grow to $20 million business and earn 3 million, that's a 5-bagger in my world. It doesn't need to become the next Google, the next Meta, the next anything, and that's the beauty of kind of microcap and kind of smaller cap investing is all you got to do is find something that can just grow revenue, grow earnings, and not dilute you. And that last part is the hard part, because a lot of companies they're there to raise capital or raise money. And quite honestly, all I'm looking for is a simple, boring business that can grow revenues, earnings, and not dilute me. And that is the next multi-bagger. And that's what that Jenga research report we were talking about earlier just showcased. It's like 91% of the multi-baggers, were profitable companies that were microcaps.
How do you think about position sizing? Because I think that would be a very interesting thing in terms of a lot of these companies, when you've got the great company, it probably just keeps going and going and going. But at a certain point, it becomes a huge portion of your portfolio. So you've got on one side conviction that this is a great company. On the other side, you've got it's maybe become something that gets too big. How do you think about that?
Well, the way I think about it is going to be different than what somebody else has to think about it, because I think position sizing, the number of positions you have, is really a temperament type of thing that you realize over the course of investing for 10 or 20 years. You kind of figure out where your sweet spot is, where you don't stay up all night thinking about something because it's too big, or the amount of positions you have and stuff like that. And then for me, I've always just been a concentrated investor. When I was a private investor and then a private full-time investor, I was mainly in 5 companies, and it doesn't, and I don't say that in a macho bravado type way. It's just, that's kind of just how I did it, and for other people, it's going to be 50 companies. I don't know. It doesn't matter. It's like whatever, however you succeed. But for me, I've always been concentrated. And so for me, what I normally do is I like to put on positions somewhere around a 4 to 8% allocation and let them run, and so I have no problems holding something that's a 25% position if it earned its right to be there, which means it went up. Where you get yourself in trouble, where a lot of stock pickers get themselves in trouble, is you buy something, it drops, so you buy more when really the business was degrading and you shouldn't have bought more, and then you buy even more. It's that averaging down that kills stock pickers over time. And so what I try to do is try to limit my initial position sizing to kind of that 5 to 8%. And listen, I'm in microcap. The reason I'm in it is because I think there's multi-bagger potential. I'm not doing it because I think it's 12.5% IRR versus 12.1, and so let the thing get big as they execute. And obviously it does reach a limit at a certain point, but as long as the business is executing and I can look out from where that company is trading today and look out 3 years and still feel that there's still another double in it. And that's kind of what I try to underwrite the positions to is, 3 years, can that stock double? And that's a 25% CAGR. It doesn't mean I'm going to be right, but that's what I'm kind of underwriting fundamentally to the business. What do I think it can get to? And as long as I see that, I'm going to continue to hold it. And unless I find something that's in the portfolio that has a higher IRR, or I find something new that's better than the worst idea.
Yeah, it's funny. We talked to Jerry Parker about trend following, and he operates in a completely different world than you, but the answer was exactly the same, which is, a lot of trend followers, when the positions get too big, they just can't handle it. They'll sell, but he will just let it run. And it seems like that's very consistent with what you're doing as well.
Yeah, I mean, it's so hard to find. It's so hard to find these things. And one thing I don't want people to think is that it's easy. If it was easy, I'd be on an island somewhere. It's really difficult. And, most microcap successes, they last for a season, call it 2 to 4 to 8 quarters, where they have one product that takes off for a period of time, and then it ends, and so you just have to be rational too with some of these companies, even the ones that I think have long-term promise. My intention when we purchase something is to hold forever, but very few, if any, will earn that right to be held forever. Our normal holding period is probably 18 months on average. And that's just because these are small businesses and the shelf life of small businesses is shorter than large cap companies. And you just have to live in that reality. The quickest way to go broke is to coffee can a bunch of these things in the portfolio and forget about them.
Yeah, and it's interesting. Like, this is one of the things I've found in my career is, for me, it's in many ways, it's a lot harder to hold winners than it is to hold losers. When you make a bunch of money on a stock, you're like, I got to take the profits. What if I lose this money? And like, as it keeps going up and you think about like the types of returns you can see in microcap or like the Amazons and the large cap space, like it's very, very hard for any kind of investor to keep holding on throughout that whole thing. The temptation to just say, I need to book some profits, I need to get rid of it, it's up so much, is probably very, very strong.
It is. And it's like, losers are easier to hold because they always look cheap.
Right.
And so it's just easier just to hold them, and the winners are always difficult because, at any, whether it's Amazon or whatever it is, you're gonna have these massive drawdowns too on top of it. And at any point in time, I mean, when you look back at any 5-year period on any major winner, there's periods where it's cheap, expensive, loved, hated. It just means that you must do the work yourself. You need to do independent research, form independent conviction so you can stand alone.
Just one more for you before I hand it back to Justin. Do you think about things like sector concentration? Like in our quant world, it could be very important, but I would think in your world, maybe not so much. I mean, if you're able to hold the positions and you have the conviction, like, do you care if a lot of them are in the same, a lot of your positions are in the same sector?
I mean, if it got really, if it's 50% of the portfolio, I would probably pay attention to it. But I mean, we're mainly trying to find kind of like I said, these overqualified management teams. And at least with our strategy, we're industry agnostic. So we have a mining company alongside a healthcare company, alongside a food company. So we're pretty well diversified across industry. And I would probably answer that question the same way I would answer a macro question. Do you worry about the economy? I'm like, no, because I have no control over the economy or where the markets are headed, but all I have control over is in finding really good investments, kind of like the filters that I kind of look at is, can this business grow through a recession? Well, that strips out 98% of companies. Does this company, this small business, actually have a balance sheet that can endure through a recession, hopefully be aggressive when their competitors aren't? Well, that's another filter. Do we think that there is intelligent fanatic leadership at this business? And I don't call anybody running a microcap company an intelligent fanatic, because that's a label that's earned after they build it into a mid cap or a large cap or something, not when they're a microcap. But we look for those character traits. And then lastly is, valuation. Do I think I can double my money in 3 years? But I think that's predominantly how we look at how to control the macro or industry concentration, is really just to make sure that we're in the best investments at all times, and being aware of what we own at all times, looking at our watch list, turning over all the rocks that we can. And we're looking for a reason to get rid of our worst idea in the portfolio. We're always looking to upgrade that portfolio. We're always looking, in a lineup of 300 hitters, we're looking to add somebody that's can bat 320. Kick out the worst one.
One of the things that's probably challenging for a lot of individual investors, if they go to a microcap company's website and they look at the management presentation, 99% of them are going to be positive about the company, as they kind of should be. You're picking up the phone and either calling or going to visit, and obviously getting to know the team and the people and doing deep dives into these businesses. But is there anything where it's an immediate red flag to you that, like, an individual investor might be able to? I mean, you kind of said it's a lot of just independent, research that you're doing. But as there, in your experience, has there been things? I'm thinking you could just do the opposite. If the team owns none of the stock, or if the company's losing money hand over fist, and maybe it's just those types of things that, for you, it's a non-starter red flag. But is there anything else that you can think of that an individual investor might be able to latch onto, to just say, no, this is not something I should be looking at?
Yeah, I mean, if you're a beginning investor, my best advice is something you just hit on, which is obviously the profitability component. It's like, I think roughly, last time I checked, I think it was 17% of microcaps in the US are profitable. So just focus on those 17%, because that'll cut out probably 90% of the issues, whether it's just a bad business or no business, or, fraud or whatever. when you have actually a real business, it cuts out a lot of the issues. Doesn't mean it's going to be a success. But I think that's a good first place to start. And I'm not saying only profitable is the right way to go. I'm just saying if you're new, that's a good place to start. Unfortunately, as you guys are probably both well aware, like how most people get an entree into the space is some glossy mailer they got in their inbox, whether it's your email or your, snail mail at your house or something like that, that's promoting the next Amazon or whatever it is. And the thing goes down 99% in 12 months and you lose all your money and you never want to look at microcaps ever again, and that's how most people get into the space. And that's how most people get a bad taste in their mouth from it. And it's unfortunate because I think it's an incredible environment to invest. But you just have to kind of use common sense, just like you said, Justin, just like look at some profitable companies where management owns a decent piece of the business. And that's probably a good place to start. And it doesn't mean that, you're going to make money on it, but just go look at all the press releases, read all the earnings calls if they have them. Are they, it's kind of like, do they do what they say and say what they do, and dive into it from there.
It's either the glossy mailer or the tip from your buddy or your uncle, that has this small cap that's going to be the next whatever. And it's, at 25 cents. And the next thing you know, it's at like 10 cents,
I attempted to sell a spreadsheet for 3 years of every one of those things I received in my inbox. And then all of a sudden I stopped getting them, probably because I was letting people know about it. But I think I collected 36 over like a 3-year period. And there was not one company that didn't go down 95%.
Oh, wow.
Yeah. It's pretty wild. But it's still, but I will say it's an incredible universe to invest in, mainly for that same reason. A lot of people just don't want to think about investing here, in this landscape, and that creates opportunity too. And there's 9,000 companies and, a lot of them aren't investable, but if you can find a handful that are, you can do really well.
How do you think about debt? Do you try to avoid companies that have high levels of debt?
Yes.
Do you dig into it in more detail or?
Yeah, I generally hate debt. I try to stay away and stay clear of any company that has debt.
And you mentioned, I think you're holding the positions, for roughly maybe 18 months or 2 years, your average holding period. But what would prompt you to sell one of the positions? There's just a better opportunity or maybe something else changes. What would be the sell discipline?
On the sell side, I would say that you normally sell for 4 reasons. 2 of them is because something good happened and 2 of them are because something bad happened. The 2 good reasons to sell is that somebody went up too far too fast. You kind of pulled forward, 5 years worth of returns in the current year. You feel like a hero and it gets too expensive, so you sell some. The second good reason to sell is because you do find something better than your least convicted name in the portfolio. So you're upgrading the portfolio. So I view those things as 2 good reasons. The 2 bad reasons, not bad reasons, but 2 reasons that, because something bad happened, the company stops performing the way you think it should. Which I guess they're oftentimes mutually exclusive. You don't trust management anymore. And if I were to put those into buckets, I would say, selling something because you found something better probably is a higher percent. Selling something because the business stops performing is high percent. You wish that the whole portfolio went up too far too fast. That's a good problem to have. And, just lack of trust in management because they did or said something that you didn't like. You feel like they're untrustworthy. That happens, quite a few times too, but not as much as those other 2. But I think turnover is part of a successful microcap strategy. I think in today's day and age of buy and hold everything forever, turnover is sort of perceived negatively by most investors, but it's really a necessity, in microcap, just because these companies are small companies and they evolve in good ways and bad ways. And probably more than half the times it's going to be negatively surprising you. And so it's just part of the process is that turnover, and even when you think about turnover, even when you look at the greatest investors ever, like Buffett or Lynch or Greenblatt, their best years are when they had 100% turnover per year in their book, and not when they had 10% turnover. And that's something I like to remind people too. And even somebody like Buffett in his portfolio today, I mean, there's a guy that's been investing for 70 years. He invests his public book exclusively, mainly in large caps because he's so big he can't do anything smaller. So he's mainly in large caps, mega caps in his public book. He's owned hundreds of stocks over the last 70 years, and he owns 15 or so today that he's owned for 10 plus years. So that just means even the greatest investor ever, he's had to own hundreds of stocks to find a handful that are worthy of holding for more than 10 years. And so just layer that on top of small, evolving, emerging, small microcap companies. Of course, there's going to be a lot of turnover.
One of the things when I was, before we had you on, I was doing a little research and I went to your capital management site, and it's very rare to see investment strategies that say, investment capacity of, in your case, $10 million in the fund and then $10 million in the SMA. So obviously you've given a lot of thought to what the capacity is, the amount of money you can effectively deploy in these companies. But just I talked about a little bit because I think that's sort of unique to you, but that's also important, right? In terms of being able to generate the returns that you're hoping to produce.
Yeah, and especially if you want to remain kind of in that sub $50 million, at least initially, hopefully they grow up and out of that 50 million to 100 and 500 million. But yeah, I mean, we are a genuinely capacity constrained fund. And I was upfront about that from the very beginning. As you guys know that, people that manage capital usually don't put upper limits on how much they can invest. We had that in our SFA. We had like a $100,000 minimum and a $200,000 maximum. And, and it worked out really well for us because I'm sure you guys know plenty of them too. It's like you see so many managers take on a big lump sum from one investor too. And, God forbid that investor leaves, they have to close up shop. And so I kind of I wanted to create a very anti-fragile kind of fund. And the way to do that is to not have a coffee table with 3 legs on it where you pull one out, or even before you pull one out, it'll fall over. I want to have one with 50 legs on it. So I'd rather have a bunch of smaller investors that understand the time frame, duration, and volatility of the type of investing we're doing. And so spend a lot of time just attracting the right type of investor into the fund. And so we are not an institutional fund. Most of our investors are small business owners, that have a $2 to $10 million net worth. And, they'd love to put $250,000 in something like this because it's not that much money to them. And they love kind of investing in types of businesses that they probably ran or managed or sold. And it's something they gravitate to. And so just been blessed with a good group of kind of small business owner investors at the fund level. And, if we're going to remain investing in these smaller companies, if they're all $50 million market cap, which they're not, but I mean, there's only so much money you can shovel down a basket of illiquid small things. And so we're cognizant of that. And so we close down the fund quite readily and we open up infrequently. And when we open up, it's usually because we drew down. And I think it's a good opportunity for new investors at the current price. And then we close back up and, we hopefully that we won't open up. Quite honestly, hopefully we don't open up again, quite honestly, because I think we'll get to 100 million in assets. We're at 25 million now, just so you know. I no doubt we'll get to 100 million, but it's not going to be from bringing on $75 million. It's going to be from going up. And portfolio, as it matures, it's going to look larger, because if we hold on to some of these winners that become small caps, the average market cap will look like a small cap, not a micro cap. But we're not going to sell them just because they grew out of our mandate or our name of MicroCap. It's just going to be a successful outcome. And so I think we'll have to evolve with it just like everybody does. I don't know where we're going to be in 10 years. I just love what I'm doing. I can kind of see where I think we're going to be in 3. And just like in the companies that we own in the portfolio, I kind of view our fund the same way where, I can only see as far as I can see. When I get there, I'll be able to see further, which is a JP Morgan quote. I kind of believe that's a good way to kind of manage things, for me as overseeing the portfolio of companies that we own. I'm always looking at 3-year increments and also kind of at the fund level too.
I think that's very important. The types of clients you're getting to invest, you're being upfront with them. you're conditioning them to be prepared to think long term, to be ready for the volatility, so they can get the most out of the strategy. Not a lot of people that run money sort of think that way, but to help them get the most out of what you're doing, it's super important for all that to be on the table. So that's very cool.
Most of my time is trying to, on the fund side with new partners, if they come in, is, trying to scare the heck out of them so they don't come in.
Mm-hmm.
The way that, I'm like, hey, if the market's down 30, we're going to be down 45. Is that what you want? If you handle that, and so you just try to be upfront with them. But it lets the right people kind of self-select in over time, and it's created a really good core group of partners that we have with us at the fund that I'm proud to call partners, and they're just normal people that you see on the street that own small businesses, and I love that more than a fund to fund trying to nitpick me on every type of quantitative metric of what the portfolio did in the month of August.
Right. I need a return attribution on all your holdings for the last 15 days. Okay. All right. So we have two standard closing questions we actually like to ask all of our guests. Usually we only ask one, but since this is the first time on with us, Ian, we gotta get two in here. So the first one is, what is one thing you believe about investing that the majority of your peers would probably disagree with you on?
When you say peers, would you say other microcap investors, or
I guess just profession? It could be microcap investors or professional investors in general. Well, what about the FinTwit crowd?
I don't like, if it was pure peers for microcap that are also microcap investors, I don't think there's too many. I don't think there's anything that my peers who are also experienced microcappers would generally disagree with me on, agree with them on. I think that it would be just like a lot of things with investing. I think alpha's generated in a lot of small ways, where we agree, but it's just executed slightly differently. And I think that's how I'd answer that question if I was directed towards other experienced microcap investors. For peers that are investors in general, but not microcap investors, I would say probably, and we hit on this already, I think just the belief that low turnover is good and high turnover is bad. I think that's where I would disagree with a lot of folks, in generally on financial and FinTwit.
All right, great. And then this last one is, based on your experience in the market, if you could teach one lesson to your average investor, what would that be?
I would say the most important thing would be just to do your own work. Doesn't mean that you can't use other people's work, but I think you need to verify that other person's work. And kind of what we talked about before, I mean, the key to this, to stock picking, is doing independent research to form that independent conviction, so you can just know what to do before other people. And even when I was a private full-time investor, I had big wins, but just that independent research and conviction and just having a pulse on that business, it was the large losses I never took that kept me in the game as much as the big wins. And so you're not able to do that unless you really dive in yourself. And I also think that's like the best resume for a younger stock picker or somebody who wants to get into it. Like, go find a couple businesses that you really like, talk to the management teams, do the work, form conviction, be the axe in that name. Know that business better than anybody else. Get loud about it on X. I don't care. I know I did back in the day. I don't anymore. But, stable your name to it. Make people know that you were the one that found that thing early. And then it goes up 1,000%. That's your resume. You'll have employers, investors, whatever, knocking down your door if you have a history of finding winners in the stock market.
Great, Ian. Thank you very much. This has been awesome. Appreciate it.
Thank you. Appreciate it.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.